Equities might be the rich kid on the block, but Bitcoin certainly seems to be getting all the attention lately. This technology is in its infancy, and yet it has attracted much attention to itself over the past couple years. Where will the price go from here? You came here for the truth, so let me unveil that for you. Today we're going to look at Bitcoin, we're going to look at gold, we're going to look at debt, and so much more. Let's begin. This chart here shows us the potential bubbles, and that's listed on the left-hand side. On the right-hand side, you get the bubble risk indicator. This font is very small. I will move on quickly, but essentially you can see that there's high, medium, and low. They have put Bitcoin into the high category, saying that it is speculation and the pursuit of new technology. Some may agree, some may disagree, that's fine. The price is highly sensitive to regulatory changes, they suggest. They talk about the numbers, where it has increased over the past couple of years. You can see the price, which has gone into a new category. It has accelerated over this past year. There's no doubt about it. I want to cover one more thing. The SPX. When you talk about stocks, specifically the S&P, the Dow Jones, we're looking at the US stocks. PE ratio is 30% above the long-term average. Now that's fine. They are higher than where they should be historically. When you compare, however, the stocks that have received central bank donations, quantitative easing, buying up shares, there's a lot of them, by the way, a lot of these stocks, but it's not the entire market. So if we look at those who have achieved a higher share price because of central bank intervention, we take those stocks, you look at the PE ratio of those stocks, and you get a whole different picture. It is a bubble. That's what we need to look at. Not just all of the stocks, because many of them didn't receive money from the Fed, didn't receive money from their central bank, and as a result, they're significantly lower than their counterparts. So address that. Always take it for what it is on a deeper level. Don't just trust what they say. Okay, look at this. We are looking at Bitcoin on a linear scale here. And you can see that over the years, it has gone to new heights. You've seen that. Everybody's been talking about it in the news. And you can see it has become astronomical. And I really was hoping that we would have seen a major correction in the price so that it could find new firm footing and it would then escalate again to new heights. But it didn't even come down that far. It took a dip, but it came right back and it went to new levels. And it makes the 2013 boom look like nothing, look like a breadcrumb on the page. But I want to show you something. That's the linear scale. The log scale, logarithmic scale, you get a whole different picture. You can see that where it was in 2013, it does escalate rather rapidly. However, this time, it's much more calm, at least in this regard. More money is going into it. There is definitely people speculating on it, trading on it, day trading. There's all sorts of different new technologies that they're trying to come up with. You know, you're seeing the CME trying to get in on this, and that's all something else. I'm just looking at this right now, okay? It seems to me that maybe the euphoria is not as high as it will get to at some point. It's not over yet. Anyway, that's what I'm trying to say. Look at this. Bitcoin priced in ounces of gold. We're very used to pricing everything in US dollars. And so we get one very linear piece of information. When you price your house in US dollars, you price your gold, you price your Bitcoin, you're pricing everything in US dollars. That's great. It's important to do that, to have a standardized way of looking at things. But when you start to measure things in other things, you get a totally different picture. Bitcoin priced in ounces of gold. Gold is up this year against the dollar, but not against Bitcoin. All of a sudden, you say, well, that totally gives me a different idea of what we were looking at a moment ago. Now, compare that to, for example, Bitcoin priced in wheat, or the Dow Jones priced in Bitcoin, or anything. There's a lot of these charts out there that are available. I think they're really good. In fact, I read a lot about this in Mike Maloney's book, as well as, if I'm not mistaken, The Dollar Crisis by Richard Duncan. If I'm not mistaken, he gets into that as well. It's been many years since I read it. That's another book for you. Let's look at this. Bitcoin's total worth is still much less than gold. 103 billion on Bitcoin, and all the gold in the world is $7.73 trillion. It's really a speck of dust in comparison. And then look at gold in comparison to the stock market. It's nothing. It really is nothing. Look at the silver market. It's even smaller. This is interesting to me when you look at the size of these markets. First of all, there's a lot of potential. If it's 100 billion and it only, let's say it doubles from here, we're talking about doubling the market cap from this point. Potentially Bitcoin at 14,000, right? We're still talking only 200 billion. I say only because we're talking about trillions and quadrillions in these markets, but it's 200 billion. That's really not that big in comparison to other markets, especially derivatives markets. So there's a lot of potential, but there's also less liquidity. And that could be troublesome when it comes time to sell. So if the market starts to fall and falls rapidly, there's going to be less and less liquidity available, and that spread is going to be very large. People need to be aware of that. That big markets mean there are a lot of places to buy, places to sell. Things are moving much more smoothly. You have less interruptions. But in these illiquid markets or less liquid markets, that you may have trouble in certain cases. Maybe not on a daily basis, but in these certain cases. So watch out for that. Also remember that if you're going to buy, whether it's a stock or whether it's a Bitcoin or any other cryptocurrency, to make sure you're buying at a place that has a lot of money moving through it. More liquidity. You need that. It's important. It's a factor that people don't think about, but it is something that you should be. This was interesting. Okay, real estate. Real estate has become, again, a speculative vehicle, and it should never be that. It should be a place, if you're an investor, you buy the homes, you rent them out to people, and you let it sit there for years and years and years, and you're just making a passive income on that property. And that is what it's supposed to be. Or you live in the house. Or you split the house. You live in one part of the house, you rent out another part of the house. There's different ways to do it, but it's not supposed to be one that you buy with no money down and then you sell it and you make 100% on your profit. Something like this is not supposed to exist in real estate. But that's what's happening. It's happening all over the world. People are buying pre-construction, they sell it before it even gets built, they turn a profit, they take that money, they throw it into the next place, and they just keep rolling it over. They're doing assignments. Assignments have become so huge, so popular, and it pushes the price up further and further to speculative levels, even though you shouldn't have this, because the average person who just wants to buy a home to live in is getting screwed over in the process. Household income increase needed to buy the median priced house with 10% down in key metros. Look at this. Areas of California are really taking the top of the charts here, whether it is San Diego, Anaheim, even Hawaii's in there. You would need, I mean, just look at this. It's insane. Some of these places, we'll take the top just as an example, 135% of what you have now to be able to have it be affordable. How does that make any sense? It's a house. It's a house. You're supposed to be able to work a few years and buy a house. Sure, maybe not a fancy house, maybe not the best house on the block, but you're supposed to be able to buy a house that's suitable for you and your family. But you can't even do that. People are moving in Toronto, for example, they're moving further and further and further from the city. And they're commuting in to the city to work. They're spending hours and hours and hours a day stuck in traffic because they simply can't afford a home closer to their workplace. And that's what it is. It's all suburban subdivisions with no big businesses that exist out there. And so you have to get a job in the core of the city, the mega city. And that's where the money is. That's where the jobs are. But you can't buy a house there. You can't afford it. So you have to live elsewhere. And then you're traveling on a daily basis, minimum 3 hours a day spent in your car, on the train, on the subway, whatever it might be. And this isn't suitable for a lot of people. But of course, what would I know? All right, household income increase needed to buy the median priced house in key cities. Bottom line, most of the largest U.S. cities are completely unaffordable to the typical end-user shelter buyer, local residents with a 10% down payment. This was interesting here. I covered something like this recently, and it's also similar to the previous chart. But the reason I'm mentioning this is here. The average of the key cities, okay, look at this one, 42% on average in the key cities. You know, you can pick up some small town out of nowhere and say, look, the prices are fine. They're not going anywhere. But let's take the key cities. That's where most of the population lives. When you look at that, 42%. 42% increase. Why don't you go tomorrow to your boss and say, look, for this to be affordable, I need a 42% increase. I want it now. And he will show you the door. That's just the way it is. You're going to take what you're given. And ultimately, people are finding themselves in worse and worse situation. It's terrible to see it. You want to know what's in a bubble? Credit. Debt. That's the bubble. All forms of it. This happens to be revolving consumer credit. You can look at this as basically credit cards. The amount of credit card debt that's out there right now is astronomical. But there are many people who have been very clever, and they have decided to use a little program that is apparently acceptable to most, but I consider this to be a terrible, terrible proposition, and it will end badly. Home equity line of credit. They take out a home equity line of credit, they pay off their credit card. They run up the credit card more. They take more equity out of their home, pay off the credit card. They need to do renovations on their home. Home equity line of credit, second mortgage. That's what's going on here. The big bubble, it's debt. Debt is the biggest bubble. Look at this. Student loans, car loans, on the up. They just keep increasing. And then they do polls about people, when are you going to pay back your student loans? They say never. Never. So what's going to happen? Well, the defaults may come if these students, of course, can't take out their home equity line of credit. They're going to default on their debt. They're going to claim bankruptcy. We're going to watch all the derivatives products. Because many people are thinking, you as an individual, you have debt. Okay, if you go bankrupt, they figure that out, get the creditors off your back. it just works itself out in the end. That's not the way it works. Your debt, whatever it is, credit cards, student loans, mortgages, they are taken from that institution, sold to another institution, and packaged up in a derivative product. Those derivative products are bigger than the stock market. Those derivative products are bigger than the bond market. They're bigger than Bitcoin. They're bigger than anything else. And these derivative products hold the worst garbage you can ever imagine, and yet they're bigger than anything you could ever imagine. This is what we are talking about here. So that's why it matters. People say debt doesn't matter. I assure you it matters. Maybe not to you as an individual, but the system that's underlying this is running off of debt. That's the fuel. You collapse it, you destroy the whole thing. If you found this video informative, please give me a thumbs up. Remember that your thumbs up, your comments, your subscriptions here do support this channel, so I appreciate it very much. If you found the video informative, I know you will find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. The links are in the description below. Take care.